Welcome to the Net Wealth Nest podcast, the show that helps everyday people build real financial stability, starting from wherever you are. Whether you're working your way out of debt or just starting to save, we're here to help you grow your net wealth to your first big wealth milestone. Each episode, we break down the mindset shifts, practical tools, and real-life actions that can transform your financial future. Thanks for tuning in. Now let's get to work building your net wealth nest. Welcome to Net Wealth Nest Podcast. I'm your host, Jim LaBeouf. Thanks for joining us again today for another episode of financial education so we can help you build your net wealth as well as just overall financial stability. Today, we're going to be talking about credit score. It is a number that dictates many of the things that you do inside of your financial life, and it is a mystery to some people on how that score is actually calculated and how banks or lending institutions or whoever happens to be pulling up your credit score is even looking at it. So let's dive right in. There are a few key things, and I'm going to list them in an order of importance on how your credit score is created or is viewed by the systems that do credit scoring. Just a heads up, there are three systems: TransUnion, Equifax, and Experian. And those are the three companies that actually take all your financial data on payments and paying stuff on time and all the other things that revolve around your credit and create this, what they call a FICO score. And so really the first and most important thing is your payment history. Every time you pay a bill on time, it's like a positive check mark. And those add up over time as you pay again and again on different things that you owe, whether it be a mortgage, whether it be your cell phone bill, whether it be a credit card bill, any of those things, they continue to add up. Anything that is reported by those institutions to the credit agencies add up and build up your score. On the flip side, if you miss a payment or go late, or you have over 90-day late derogatory mark, or you have even worse collections filed on you, that is going to negatively impact your score. The disadvantage with the negative marks is they actually are more impactful than the positive marks. You need a lot of positive marks to build up a good score. You don't need that many negative marks to really wreck your score. So payment history, incredibly important, makes up over 30% of your entire score. Credit utilization. This is confusing to some people, but really what it means is how much are maybe your credit cards or loans giving you to use, and then how much of that are you using? So let's say you have a credit card and it just has a really easy balance. It's $100 and you're using $50 of that is on that card when it is pulled by the credit card company and that information is given to the credit agency. Let's say that you have $50 of the 100 you can spend. You have a 50% utilization rate. What banks want to see is that number under 10%. When you see that number get over 50%, and especially as we get to 70, 80, and 90%, you become very risky to the bank where you don't have a lot of outs, meaning that you're using all the money that is given or put in your possession to use in different situations. And that means that you are probably living well beyond your means, and they may not want to lend you any more money because they're worried they're not going to get paid. The next one is length of credit history. So the longer you can start any type of credit history and the longer that plays out, the more safe that banks and other lending institutions see you. Credit cards, student loans, any other loans, mortgages, car loans, cell phone bills are sometimes reporting it now. There's also other companies that are reporting different things like your utility bills as those get paid. Again, as those things get paid over and you have a long history of doing those things, that bodes well for your credit score. Then they'll look at types of credit, and that just means, is it credit card debt? Is it a mortgage? Is it a car loan? What kind of debt do you have, or what kind of credit do you have out? With credit card debt, or what they call high interest revolving debt, being the worst. So if that's all you have, it's not going to be a great benefit to your score, versus if you have a mortgage, as an example, where the lending institutions typically view that as a more stable type of debt, it'll make your score better to have that debt versus having the credit card debt. And the last one is inquiries, or how many times that you're requesting credit from somewhere or someone. The more you do this and the more frequently you do this, the more risky you seem to anybody who wants to do anything from lending, or when other organizations that might not be lending you money, but they're doing other things, getting you set up for an apartment if you're renting, those sorts of things, they're going to view a lot of inquiries as a riskier situation than if you only had a few every once in a while as you needed them. Many people that are in massive debt are continuing to try to open up new credit cards and do new things so they can spend more money or try to move around more money or whatever they're doing with that. But it just looks risky. It's not a great situation to be in. So those are going to be the main things that your score is derived upon. Why is this important? Why is your credit score important? And so we foreshadowed this a minute ago, but your credit score can lead to a lot of different things. Most people understand that your credit score is going to determine if you can get a loan and how much interest you're going to pay on that loan. And that could be a loan for anything. It could be a loan for a house, it could be a loan for a car, it could be a credit card. Any of those things, when you go to apply for those credits, your credit score is going to be pulled and they are going to look to see if you are a risky investment for that institution or if you are a safe investment. The more safe you are, the better your credit score, the more likely you are to not only get approved, but also get a better interest rate. And also, depending on what you're applying for, like if you're applying for a loan or a credit card, you might get a higher amount of money approved because you have a really good credit score. Beyond that, the other thing that's important that most people don't understand is a lot of other organizations now are pulling credits to determine if you're going to be a safe bet in whatever they're doing. So we'll talk utilities as an example. Many utility companies now are pulling credit. And what they're doing is if you're having poor credit, they're making you pay an amount ahead of time called a deposit, just like we would if you were renting an apartment, right? You're putting on a deposit, sometimes up to a couple $100 to make sure that if you all of a sudden stop paying your utility bill, most of the time they don't like to turn those off because most people need electricity, heat, water to live. And so having that deposit where they can pull from those funds while they figure out to get you to pay or give you enough warning time before they do shut it off is really important. And that's just a tax on your life of not having a good credit score. If you just had a great credit score and were just really good at living within your means and paying your bills on time, you wouldn't be charged those extra fees. Now, the cool part is you do get that money back in most cases. But again, you still need to come up with that money sometimes in advance to be able to get basic things turned on like water, electricity, or heat in a new apartment or home. The other thing to think about is when you're renting. If you're renting an apartment, most landlords are going to pull a credit score and they are going to have a minimum floor. And if you are under that minimum floor, they are not going to rent to you based on risks that they are worried you are not going to be able to afford the rent. We're even seeing now is insurance is pulling credit history to make sure that you can pay your car insurance or your renter's insurance or your home insurance. We're seeing it in even things like entertainment, where DirecTV will pull it to make sure you're going to pay your bill, or even YouTube TV. They're starting to see this in all aspects. And that's why it's so important to have a good credit score is you don't want to have to put down these deposits, or if you get approved for a loan of some sort, have a high interest rate or higher than what you need it to be, or getting declined for a loan altogether. Building upon your payment history and the length of your credit history to ensure that you are really driving that score higher and higher is super beneficial in almost all aspects of your financial life. The last thing that most people take for granted with having a good credit score is just peace of mind of knowing that even if you get in a hard situation where you need to get a credit card or you need to do something like this, or you need to take out a loan that maybe you didn't anticipate or any of those things, having a good credit score is just that feather in your cap that says, I have a history of making my payments on time all the time. I have a history of being a safe bet for anybody that needs to pull my credit. I don't need to worry about this. And typically, once you get above 675 to a 700 credit score, you're going to live in that range. Now, credit scores can go all the way up to 840, I believe. Once you get above 700, you are viewed as a safe bet, no matter what is being pulled, whether it's just to look at you for utilities and see if you're safe and creditworthy, or whether it's to try to get approved for a loan. 700 and above is going to get you some of the better rates. It's going to get you some of the better terms, especially when you're applying for mortgages and car loans. Don't discount your credit score. Make sure you have an idea what it might be. If you don't, there are ways you can figure that out. So you can go to free systems like Credit Karma is a great example, where it will give you a rough estimate of your credit score. Now, these are not necessarily 100% accurate, but they're typically close to what your actual credit score would be. The reason they're not 100% accurate is they're just pulling off of public data and they're not actually sourcing the same type of software that Experian, TransUnion, and Equifax give to a bank as an example. But they do give them enough to give you a really good idea within usually 20 to 30 points what your credit score would be. And sometimes it's almost spot on. So I would recommend having that so you can at least get an idea. Also, once a year, you can go on the governmental website for credit and you can have pulled your credit report for all three institutions, and that is 100% free to you. And the reason that is important is it doesn't give you your credit score. It does show you everything that they are taking into account. Every single credit card, every single loan, every single monthly payment, all those things are on there. And if you start to see things that are not yours or that you're questioning, you can reach out to somebody and figure out what those are. Those could be signs of identity theft. And we also want to protect against that. So it's just really important to keep track of your credit, keep track of your score, keep track of your credit report year in and year out, and make sure that you're watching those things. So A, you can continue to build up your credit and have great credit. And then B, you're protecting yourself from any type of financial harm via identity theft. That's all we've got for today. A basic overview of your credit score and how to look at it and how to improve it. Thanks for joining us today. Please, if you have any questions, leave them in the comments. We'd love to hear them, and it helps us drive what our next episodes will look like. Again, my name's Jim. Thanks for coming today, and good luck on building your net wealth nest. Net Wealth Nest LLC and Podcast is an educational platform committed to providing resources and information to empower individuals on their financial journey. Please note, we do not provide financial, tax, or investment advice. All financial decisions should be made in consultation with a qualified professional who understands your unique circumstances. Seeking personalized advice is a smart and necessary step before making any major financial commitments. Thanks so much for joining us today. If you found value in this episode, please like and subscribe to our YouTube channel, Net Wealth Nest, and leave us a review on your favorite podcast platform. We read every comment, and they help us improve and guide what topics we dive into next. And hey, if something you heard today resonated with you, don't keep it to yourself. Share it with a friend, a family member, a coworker, your barber, your barista, even a stranger in line. You never know who might need this message. Remember, building net wealth is a journey, but you don't have to do it alone. Stick with us, and together, let's grow your net wealth nest.